Welcome to this Bradley Nuttall Otago Limited Financial Markets Update, where we'll update you on developments over the second quarter of 2020. My name is John Alexander, and along with my colleague Fraser Richardson, we'll take you through an overview of the last quarter.
The lockdowns imposed in a number of countries sparked a plunge in GDP figures. Gross domestic product fell as much as 20% in some countries in the second quarter of this year. The International Monetary Fund estimates that GDP will drop almost 5% over the course of the year, causing the worst global recession since the Great Depression of the 1930s. Although IMF estimates of the economic damage caused by COVID-19 have steadily worsened, the IMF still expects a quick recovery in 2021. Global GDP is forecast to grow by 5.4% in 2021, after falling 4.9% this year. Governments and central banks around the world reacted to the coronavirus by slashing short-term interest rates and pledging to step in to buy financial assets where necessary. This had the effect of underpinning government bonds and other financial instruments, and led to a remarkably quick recovery in riskier assets, including shares. Most major asset classes recovered the majority of their first quarter losses in the second quarter of this year, with particularly strong gains in developed equity markets. Australasian equity markets were no exception, with gains of between 15 and 32% over the quarter in the managed funds we recommend. Shares also performed strongly in developed markets outside Australasia. Gains were especially good in funds hedged to the New Zealand dollar. In fixed income markets, first quarter losses were short-lived as the actions of central banks around the world had the desired effect. All of our fixed income funds more than eradicated their January to March losses and are up significantly year to date.
Our model portfolios recovered strongly following the market decline of March, which was associated with coronavirus. This was especially so in the more aggressive portfolios, which are more heavily weighted toward shares and property. Turning to longer-term performance figures, 10-year returns now exceed their long-term expected returns in all except one standard model portfolio, which is our most aggressive portfolio, the 98-2 portfolio. In our socially responsible investment portfolios, which screen out investments in sectors including fossil fuels and arms manufacturing, the second quarter recovery was even stronger. 1-year returns are well into the black, and 10-year performance figures significantly exceed expected returns over this period. Thanks for watching our presentation. If you'd like to talk through your own situation, just contact us by phone or email.